You are about to find out the key levels for GNS. So to get straight into it, firstly, I want to cover, obviously you can see this stock is very volatile. You can go back, basically January, we were sitting at 30 cents. You then fast forward to February, we were sitting at basically $8. So this stock can move, and right now we're back down around 80 cents. This stock is a big mover. Does this mean you should buy? So personally, from how I trade, not going to be something I buy. I don't like kind of throwing in money, anticipating that there'll be a move, basically just bag holding till then. I think there's still quite a lot of risk if you're doing that, unless you're really just throwing in what you're willing to lose. But again, still to me seems like an unnecessary risk. So instead I take the other approach. I know this stock can squeeze, I know it can fly. So then the way I want to trade it is basically trade those levels short buy. So if we squeeze out really any level above these 260, so 260 is our first deviation. So this is when the stock becomes a bit more overbought. However, again, especially if we zoom out further, this stock, when it does run, or when it does kind of squeeze, it can squeeze quite far. I mean, even if you go back to this one, it can go far and will normally get to completely overbought before it starts to fall in price. So that means the way I look to trade this is I don't even really bother with the first deviation. Won't probably even bother with that second deviation. What I'd wait for is a really strong move on the stock, and I'd want to see a move to that third deviation, which right now is around $6 to $6.10. So that's exactly what I'd want to see on this stock. I won't trade it until we make that move, and then once we're trading at or above that $6 mark, I am then completely short bias on this stock. Again, might hold out for several days, but overall, we know it's most likely not going to hold. Most likely, we're going to fall down. So if we can get shares available to short, that will make the trading opportunity a lot easier. We can just short the shares, buy calls to define the risk. Because again, this stock can squeeze. We don't want to be holding that naked. That would be or open us up to a lot of risk. Go shorting the shares, buying calls to define that risk. If we can't short the shares, then we can play the options. And what I'd be looking to do, maybe go out 2 weeks to 2 months. And then really just look to play the puts, outright puts or vertical spreads, which is buying a call and say shorting a call, with a bit of a difference between the strikes price. And what that would do is give you a defined upside, defined downside. But you normally get about a 1-to-1 risk to reward on a trade like that. So if the chances are we're here, we give a 2-month out expiration just to say it'll be below $6. Chances are, like we've seen time and time again, it will fall in price. So again, the level I'm mainly paying attention to is above $6. And again, if I was someone who holds and looking to play the squeezes, again, I'd probably be taking those main profits around $6. But again, that's my main watch for this stock, is I won't pay attention into it until it squeezes. So I mean, I can literally just set an alert up around $5.50. If that goes off, then cool, I'm happy to trade it. In the meantime, I'm not touching, not going to bag hold, not going to touch this stock in any other way. I hope you guys enjoyed the video. If you did, why don't you check out this video, because you'll probably enjoy that one too.